Welcome to a video that I call the What to Watch video. Every week I do a number of different videos. I do a video each day. I do a weekly video. I do an intermarket analysis video each week. The last video I do is called the deep dive video. And then when I get through with all of those videos, I pick out the charts that are really staring at me right now, and I put them together into this video. And these are the things that I will be watching. Now, I typically prepare this video once a week, but if there's a big change in some of the charts or the climate that we're seeing, I will update this video on an as needed basis. However, for the last number of weeks, I've only been able to record this video once a week because things haven't changed all that much. We are turning a little more negative now. We're still looking positive when we look at the whole big picture, but we want to keep an eye on things as we potentially could see either a pullback or, if it becomes really aggressive, more of a decline. This is being prepared for Monday, March 18th. First, I look at those things that are positive, and I go through that in a list here, and then I go through a list of those things that are negative, and these are just different things that I'll be watching. First of all, the markets are anticipating rate cuts to be slow. If you've watched another one of these videos, I've been talking about that. The market's still maintaining that stance for right now. However, in the past week, we had CPI and PPI come in pretty hot, and that has really rattled the markets a little bit. It's bumping interest rates back up, and now the market's kind of having to rethink this, not so much about how the Fed's going to cut interest rates, but if we start to see a real continuation of stronger than expected economic reports, rates are probably going to stay the same. And if they get really strong, we might even see the Fed come in and raise rates. And I've even heard a few people mention that, but right now we're just going with what we see instead of trying to speculate too much into the future. On the positive side also, this past Tuesday when the CPI report came out, we did set a new all-time high for the S&P. Now that's very strange. The report came out hotter than expected. We saw futures first going down, but then by the time the market opened, we ended up going up thinking, well, okay, the CPI came in hotter than expected, but we think down the line it's going to be weaker than expected. So we're going to take the market higher. The S&P ended up setting an all-time high on that day. So even if we're starting a pullback or a decline, we just had in the previous week an all-time high for the S&P. So far, when you look at all of our charts together, we are still positive. We still have some overbought indications, especially in the intermediate term. In the short term, we pretty much have worn all of those off. Now, for me, the short term is days to weeks. The intermediate term is weeks to months. And then the long term is months to years or even decades. So we want to keep an eye on the intermediate term right now. That can be more of a gradual shift, either back more negative or if we maintain more of a positive stance. We are seeing some weakness starting to develop, and I'll go through that as I go throughout this video. The S&P is still above long-term resistance. This is a weekly chart where we're hitting a monthly pivot point that's at the 51.10 to 51.11 level. We're just about 6 points above that, but we're still above that level on a weekly chart, so that made the Friday close to finish out the weekly chart still look a little bit more positive. Now, we may fall below that, but at the same time, the fact that we're still above it can be taken as positive. The end-of-day growth-to-value ratios have been holding up, but they are showing some weakness when we saw the downturn in Thursday and Friday sessions. Discretionary to staples still doing okay, but it's been showing some weakness as the market has been pulling back. The S&P 500 is still in an uptrend, but there's a couple of short-term trend lines that I'll show you later on. We broke below both of those. And the next level down below that is the 20-period moving average. The S&P for right now, though, is still above its 20-day moving average. And that's the next layer of support. The S&P parabolic SAR, and this is an indicator that I put a lot of importance on, it's still positive for right now. If we see more declines, it may switch over and actually turn negative. And then when we look at the QQQs or the NASDAQ 100, all of the trends are still positive, but we did drop down below its 20-day moving average. That had held up as support a while back. We bounced up off of that after having a pretty severe down day. It didn't hold this time. Now we're going to be looking to the S&P 500 20-period moving average to see, is that support level going to hold? And then the short term and then the really long term support for the QQQs or NASDAQ 100 is continuing to hold. And I'll show you charts of all these things here. This is the idea that if the Fed is able to cut rates more slowly, then stocks tend to do better because the Fed is reacting to what's happening in the economy. Maybe it's getting a little hot, maybe it's getting a little cold, so they cut rates instead of some catastrophe that happens like a 9/11 or a great financial crisis. Now, something like that could happen, but it hasn't happened as of right now. And so all we can do is focus on what is happening at this present time. If the Fed does come in and cut rates because of some bad event that happened, that tends to be negative for stocks because the economy is kind of fighting for its life at that point. Here is the weekly chart of the S&P 500, where we're just barely above this R1 level. And as I've been pointing out, what makes this so important? Well, when we were really going up back in 2021, we hit one of these weekly pivot points. That ended up being the high right at the end and then in the beginning of 2022. And then we spent 2022 pretty much going down. We bottomed in October of 2022. Then we started going back up. And then in July or August of 2023, we hit this pivot point again. And then we spent the next few months going down. Now we've been going up. We're a little bit above this. And notice this is looking a little more positive. We never got above this last summer. Now we've had 2 bars that have actually been above this pivot point here. So that's positive, but we're just a few points above this level. We're at 51.17. This is 51.10 to 51.11. So just about 6 points above it. If we see, and it's not so much on an intraday basis, if we close below this, that would turn things back more negative. Then we're looking at growth to value, and we look at it not only in the S&P, but also in the small caps, where we had been seeing a lot of improvement with the small cap growth to value ratio. And we're seeing some weakness now, and the small caps really are underperforming. But so far, this continues to hold up. We also are pulling back when we look at mid-cap growth to mid-cap value, but it is seeing some recent weakness here. But longer term, it's still in an uptrend. This is the one that I focus on, S&P growth to value, where growth is still in an uptrend, but it has been pulling back lately. So for right now, this is positive. But if we see more follow-through weakness and we drop down below these moving averages, that's going to turn things even more negative. We also been keeping an eye on discretionary versus staples. I focus on the bottom chart, which is the ratio between the two. When this is really going up, which it's in a longer term uptrend, but lately it's been showing some weakness. Up here in the second area, we have discretionary and equal weight ETF, and then we have the staples equal weight ETF. And the staples is actually generating a death cross now. So that's something to be aware of here, where we're looking more positive when we look at discretionary, but discretionary has really been underperforming. And this has a lot to do with Tesla, one of the Magnificent Seven stocks that has really been under pressure. Here are 2 trend lines. The first one I just drew from the October low and then a series of lows that we were making. Well, we finally closed down below that. So then I noticed some other lows that we were making here. So then I drew the blue line. Well, now we've closed down below both of these. Now, this is still positive, meaning that we're still in an uptrend. And this just means that even though we're in an uptrend, we're at minimum slowing down here. And so since the trend is still positive, that's why I have it in the positive section. If we see more follow-through weakness, this could turn more negative. And then here's the 20-period simple and exponential moving averages. I use both of them, and I plot both of them on this chart. We still have been able to stay above both of these moving averages. And again, we could fall down through this intraday. It's where we close is the most important part. As long as we stay above that, this could end up acting as short-term support. If we fall below this, then we'll be watching the 50-period moving averages. That's kind of the more intermediate term level of support. Then here's the parabolic SAR. When the dots are underneath, that's positive, and that's what we're seeing. But if we see some more weakness, we could see a switch where the dots end up going up on top, and that would turn this intermediate term indicator over to negative. But for right now, it's positive. Looking at the NASDAQ 100, we've been bouncing in between pivot points, and this seems to be pretty important for the NASDAQ. And the cool thing about pivot points is these are on the chart before that day even happens. And so we can watch these ahead of time. We hit this R1 level, and that's acting as overhead resistance. We've been falling back, but for right now, this pivot point right here, we're just a little bit above that. So that is still holding. If we can bounce up off of this, that would be more positive. If we fall back down below this, that would be more negative. And then here's a weekly chart of the NASDAQ 100 and a trend line going all the way back to 2009. We're coming right back down to the trend line. We're still just a little bit above it right now. So that's also long-term positive. So in the short term, looking at the pivot points, because these are daily, and then long-term, looking at this weekly chart, that's why I say we're still maintaining an uptrend. Now we look at the negative side. Our intraday growth to value ratios are showing some weakness, and some of those I've been showing you. Interest rates are rising. Now, a few weeks ago, interest rates were going up and stocks were going up. It's like stocks didn't care. Well, now, because of the CPI and PPI report, interest rates are going back up, and now this is causing some concern for stocks. The S&P 500 50-period moving average, and that's one of the ones that I really focus on more for the intermediate term. It's showing some weakness now. We have the bullish percent index for the S&P. It's falling after being extreme positive. When we get a reading below 70, that's when it's no longer extreme, and that's pretty much a sell signal at that point. We're just a little bit above 70. If we close down below that, that would be more negative. The NASDAQ 100 bullish percent index, it not only has dropped below 70, it's dropped below 0, and it's actually turned negative now. Sentiment is declining after being extreme positive. The point and figure chart is giving us a really extreme positive reading. The McClellan oscillators for the S&P and the NYSE. The S&P is what I focus on, but then as a broad market measure, I look at the NYSE. That's more broad-based. They are both turning down based on price and volume. And then the vortex is still positive, but it's starting to decline, and the green line's on top, but it's dropping below 0. The NASDAQ 100 or QQQs did close below its 20-period moving average. And then the transports, this is longer term, and we've been watching this even when the market was going up. They continue to negatively diverge from the Dow and the S&P. Small caps continue to underperform. The NASDAQ and the Dow ratio, it's right at that all-time high ratio. And we're wondering, is that a top, or are we going to be able to go up from there? And then also the QQQs to IWM. This is the NASDAQ 100 to the small caps. This ratio has been declining from previous highs. And if you think about that, QQQs, that's the NASDAQ 100. That's where all the strength has been coming from. That's where the Magnificent Seven is located. And if they're going down in comparison to small caps, which have already been suffering, that could be quite negative for the market. And then the dollar's been going up a little bit. When the dollar goes up these days, that tends to put pressure on stocks. And then we also potentially could be coming into a time of weak historical seasonality. Okay, let's look at some charts. This is an intraday chart based on 10 minutes where we have a blue line. I always want to say green. We have a blue line, which is growth, and the red line, which is value. In a more solid environment, we want to see the blue line above the red line, even though they're on different scales. Well, now they're pretty much right on top of each other, and over Thursday and Friday session, we saw this starting to show some intraday weakness. Here is a growth to value ratio for the S&P, another 10-minute intraday chart. It had been showing some improvement, but then we hit, actually this is Thursday where it held up quite well, but then in Friday's session, we really saw it break down. It hasn't broken down completely yet. We just want to keep an eye on this. If this continues to fall, that would be more negative. If it can bounce, even if we're going down, even if this is still going up, that means that there's some strength coming into the market. We're just not seeing that reflected in the index. And then here's interest rates where we're climbing back up with the 10-year yield. That's really the benchmark that I follow. We had been declining with interest rates. Well, then CPI and PPI came out and interest rates are starting to go back up, which is pressuring stocks. Here's the 50-period simple moving average. We had been seeing some improvement, but over Thursday and Friday session, this is starting now to show some more weakness. If this continues to fall, that would be more negative. If we drop down below the 50 level, that would even turn things more negative. Here's the bullish percent index, and it's above 70, just barely, but it had been going up. And that's okay when we get above 70 and we're going up. But when we turn and start to come down, that's when we really take notice of this. If we fall below 70, that would turn things even more negative. This is more negative. This is the NASDAQ 100, the real backbone of the strength of the market these days. We had been getting very high readings. It fell down below 70. Now it's starting to, I think I said zero. It's falling below 50 now. So this is actually turning negative where it had been positive. This is looking at sentiment where we had been up at the 75 level, and we may bounce and go back up, but we have to look at the context. We were getting a high reading, and now we're starting to come down. So now that is more negative after giving us an extreme positive reading. This is the point and figure chart, which just has a whole lot of X's right here. And usually that would be positive. X's mean we're going up. O's mean we're going down. A point and figure chart does not take time into account. So however much it needs to move to draw an X, whether it takes an hour or a year, that doesn't matter to a point and figure chart. So when we're going up, we see X's, but up here on the top, it says a long, tall up. That just means that we're seeing an awful lot of X's without much of a pullback, and maybe we're going up too far too fast. We saw this a week ago, and there hasn't been any change in this. This was initially triggered on the 7th of March. This is the summation index, and this is more intermediate to even somewhat long-term, where we measure this based on price. And when this is going up, we tend to be in an uptrend. When this is turning down, that's showing more weakness. We're starting to turn down based on price and volume. We're above this red line here, which means that we were getting kind of an extreme reading. We were a little bit concerned about this because as the S&P was going up, we were not seeing corresponding rises in the summation index based on price or volume, and that's a negative divergence. And now we're wondering, is this starting to lead to something? Is this negative divergence meaning something more now? Then we look at a broader measure of the NYSE summation index based on price and volume. Now, the broader market for right now is holding up a little better. Yes, it is in fact turning down based on price and volume, but it's probably really hard to see. So you kind of have to take my word for it unless you want to try to zoom in really hard here. And then this is the vortex. When the green line's on top, we're positive. When the red line's on top, we're negative. The green line's on top, but notice how it's been negatively diverging from price. It's been getting weaker and weaker, and now it's starting to drop below the midpoint. So it's still positive, and as long as it's above the red line, that is positive. But the fact that we're dropping down below this line, and then if we eventually see the red line cross above the green line, that would turn things more negative. Here are the QQQs. This blue line is the 20-period moving average. We bounced up off of this week before this past week, and that gave us some good solid support. Well, now we closed down below that. So this support level has been lost for right now. However, when the blue line is above the red line, this is a 50, and then the red line is a 200-period moving average. That just means that we are in an uptrend. And then we have a really long moving average down here showing that the long-term uptrend continues to be positive. We're also looking at this longer term. This is basic Dow theory. We're just coming off of setting recent all-time highs with the Dow, and we're going sideways to now declining with the transports. That means there's a non-confirmation here based on Dow theory. Eventually, to confirm this, we want to see the transports turn and go up and set a new all-time high that was set back in 2021. They have not done that yet, so this is a non-confirmation. And utilities are something that I include as part of Dow theory, but I'm not really talking about it here. They have been in a longer-term downtrend. And then we look at a ratio between the transports and the S&P 500, showing that the transports just continue to underperform. Small caps also continue to underperform the S&P. When we do a ratio between the two, even though we see a little bit of a bounce here and there from small caps, they're not showing any more sustained strength right now. Then this is a longer term chart. This goes all the way back to the year 2000. This is a ratio between the NASDAQ 100, which is growth, and the Dow, which is kind of considered to be value or the best of the best stocks. And we ended up hitting a really high reading back in 2000. And then right after this was the dot-com bust. And then it took us many years to get back up here. Right at the end of 2021, we came back up to this previous level again. And then we went into 2022. Now we're back up to this level again. And we actually got a little bit above it. We're pretty much right at this level currently. And this is longer term, and we'll be keeping an eye on this. If this really starts to fall, that could turn things more negative. If we stay more positive, this ratio should, in fact, start to go up. This is a similar chart. This is comparing the QQQs of the NASDAQ 100 to the IWM or the small caps. We came up to the previous high reading here in this ratio, and we are starting to decline here. So we want to keep an eye on this one too. Here's the dollar index. Even though it's below both moving averages, we could be getting ready to see a golden cross. We've been bouncing back up just a little bit. The dollar started off 2024 by seeing some strength, and that was pressuring stocks. Then it started to decline. That was where stocks were getting more support. Now it's starting to go back up a little bit here. We just want to keep an eye on that one too. And then looking at seasonality, we haven't really been following it all that close, at least over the last week or two. But historically, what happens is we see a bounce up in the early part of March, and now we're coming in to more the middle part of March, where seasonally and historically, we might see some weakness going into the latter part of March. And we're just wondering if that is going to develop. Thank you. I really hope you found this helpful. Please feel free to check out all the other videos that I post to get the entire picture together. I hope you have a really good weekend, and I will talk to you in the next video.